Vistra completely missed Q2 2026 consensus estimates. Revenue came in at $4.02 billion. That misses the $5.73 billion consensus by a massive margin. And adjusted EPS was $1.68, which also missed the $2.05 estimate.
Yeah, but right after dropping that huge top and bottom line miss, management just stepped right up and reaffirmed their full year 2026 guidance. They are sticking to the adjusted EBITDA target of $6.8 to $7.6 billion.
Right.
And they also reaffirmed adjusted free cash flow before growth. That's staying at $3.925 billion to $4.725 billion.
So if you're looking at your portfolio this morning, you see a stock with a $1.71 billion revenue miss. You expect an absolute bloodbath.
Oh, totally.
But instead, you get this really cautious pre-market dip of 1.46% to $139.32.
Yep.
It did hit an intraday low of $134.75, but it entirely avoided a sharp sell-off.
Which is pretty surprising on the surface.
Right. So today we are taking a deep dive into Vistra's Q2 earnings call, their latest filings, and this major new infrastructure partnership they announced to figure out why a miss of this magnitude barely made the market flinch, and, of course, what it means for your capital going forward.
Because the market's reaction, it basically tells you that institutional investors are looking right past those headline numbers. Those GAAP figures, the revenue, and the EPS, they are essentially an accounting illusion in this specific sector.
An illusion? How so?
Well, they're masking the underlying operational cash flow. When you analyze an independent power producer or an IPP, the headline net income is almost always heavily distorted by non-cash derivative movements. It's just noise.
Okay, let's break down the mechanics of that distortion then. Because when retail investors see GAAP net income fall 6.7% year over year down to $305 million, the instinct is to just head for the exits. What exactly is dragging that number down on the actual balance sheet?
Right. So the anchor dragging down that net income is a $472 million non-cash, unrealized mark-to-market loss on commodity hedges.
That sounds like a lot of jargon.
It is, but here's how it works mechanically. Basically, Vistra generates electricity. To protect themselves against wholesale price volatility, they sell that power forward, meaning they sign contracts today to deliver power months or even years from now at a completely locked-in price.
So they're securing their future revenue stream, basically.
Right, exactly. But because forward power and natural gas curves fluctuate every single day based on weather forecasts, supply constraints, geopolitical news, accounting rules actually require Vistra to mark those future contracts to their current market value today.
Oh, I see.
So if the market price of power suddenly spikes way above the price Vistra locked in, the contracts they previously sold show a paper loss right now. And the key term there is really paper. It has absolutely zero impact on the actual cash Vistra generated during this specific quarter.
So it's kind of like a homeowner buying a really expensive multi-year insurance policy for a beachfront property, right?
Yeah, that's a perfect way to look at it.
Because if you just look at their checking account, on the day they pay that massive premium, it looks like they're burning through cash at this alarming rate.
Yeah.
On paper, their net income for the month is terrible.
Exactly.
But structurally, they've locked in the long-term value of their underlying asset against, a catastrophic hurricane or something.
Exactly. The GAAP net income reflects the immediate cost of that financial protection, but it completely ignores the actual cash-generating power of the physical house itself.
Right.
If you want the reality of Vistra's quarter, you have to look at their ongoing operations adjusted EBITDA. That is the metric that strips out all that non-cash derivative noise and looks strictly at the cash the business is actually throwing off.
And what does that look like?
Well, when you isolate that metric, adjusted EBITDA actually surged 30.8% year over year to $1.767 billion.
Okay, hold on, though. Retail investors are constantly warned to be suspicious of, adjusted metrics because management teams love to just exclude all their mistakes, right?
Sure, that's a fair concern.
If you are holding Vistra stock, shouldn't you be a little worried about a $500 million paper loss? Doesn't the loss of that magnitude indicate that they fundamentally misjudged the market and basically sold their power way too cheaply?
It definitely looks that way on the surface, I'll give you that. But you have to understand the core philosophy of an IPP's hedging strategy. Their mandate is not to perfectly time the peak of the wholesale power market.
What is it then?
Their mandate is to secure predictable, stable cash flows, period. As of this earnings report, Vistra has hedged approximately 100% of their expected generation volumes for the rest of 2026.
Wow, 100%.
Yep, and 94% for 2027. By aggressively locking in those prices, they virtually guarantee they're going to hit that $7.2 billion midpoint EBITDA target we talked about earlier.
So they are intentionally leaving upside on the table.
They are. They totally are, in exchange for certainty. Yes, if summer temperatures break records and prices spike, they miss out on some of that unhedged margin, which creates that exact accounting paper loss we just talked about.
Right.
But they also completely eliminate the downside risk if natural gas prices were to suddenly collapse. For a company that's, managing significant debt and funding billions in heavy capital expenditures, having absolute cash flow certainty is vastly more valuable than gambling on these unhedged merchant spikes.
That makes sense. But locking in certainty doesn't organically generate a 30% jump in EBITDA. I mean, that requires actual physical execution. Let's look at where that operational cash generation actually originated within the fleet.
Okay, so the growth was driven almost entirely by the generation business. Vistra's generation segment posted $994 million in adjusted EBITDA. That is an outsized 67.6% jump year over year.
That's massive. And what about the retail side?
Meanwhile, their retail side of the business, the side that sells power directly to consumers at fixed rates, that was highly stable. It was up just slightly to $773 million.
Okay, so a good balance.
Yeah, the synergy between those two segments is exactly why Vistra's integrated model works so well. The retail side provides this really stable baseline, but the generation segment was just the absolute star this quarter.
The metric that really jumps off the page in the generation segment is the margin expansion. Vistra expanded their EBITDA margins to 43.42%.
Which is huge.
Yeah, because Wall Street analysts had estimated like 29.65%. You don't beat margin estimates by 1,400 basis points by accident. How exactly did they squeeze that much profitability out of the fleet in just a single year?
It basically required a combination of highly favorable macroeconomic conditions and just flawless operational readiness. First off, they captured higher realized prices across their open merchant capacity.
And that's the unhedged portion.
Right. That is the portion of their power they intentionally leave unhedged so they can sell it at daily market rates. Second, they benefited significantly from higher capacity revenues in the PJM market.
PJM's the big one in the East, right?
Exactly. PJM is the massive regional grid operator that covers 13 eastern states. In PJM, power plants are paid capacity revenues simply for being available to generate power during peak demand, regardless of whether they actually have to spin their turbines.
Oh, nice gig if you can get it.
Right. And those capacity clearing prices were highly lucrative this time around.
But they also had some strategic physical assets come online right at the perfect time, didn't they?
They did. They successfully restarted Martin Lake Unit 1, which brought critical high-margin megawatts back onto the Texas grid exactly when demand was surging.
Talk about good timing.
Seriously.
Yeah.
And finally, you are really starting to see the accretive cash flow contributions from their recent Lotus acquisition. Adding those highly reliable nuclear baseload assets to the portfolio is starting to materially hit the bottom line. It was essentially an operational masterclass meeting, a very high-pressed wholesale environment.
Here is the sticking point for anyone trying to model Vistra's future earnings, though. Both the PJM grid in the East and the ERCOT grid in Texas set new all-time summer peak load records in July.
Yep, it was incredibly hot.
PJM hit over 168 gigawatts, and ERCOT broke 91 gigawatts of demand. If you are building a 5-year discounted cash flow model, you have to ask yourself, are these juicy 43% margins actually sustainable going forward? Or was this just a lucky quarter totally subsidized by a historic summer heat wave?
That's the billion-dollar question.
Because you really cannot build a long-term investment thesis on the hope of extreme weather every year.
Well, if you look closely at management's forward commentary, their entire thesis is that these margins are structural, not just meteorological. The extreme heat certainly provided a great short-term tailwind, sure, but the underlying baseload demand on the grid is rising regardless of the weather.
Really, how fast is it rising?
Management continues to forecast annual load growth of 4% to 6% in ERCOT and 2% to 3% in PJM all the way through 2030.
And that baseload isn't just coming from residential air conditioners, I assume.
Not entirely, no. It is being driven by heavy industrial reshoring, the broader electrification of the transportation sector, massive population migration into Texas, and most importantly, the aggressive build-out of digital infrastructure.
Ah, the data centers.
Exactly. The July heat wave just exposed how tight the supply-demand balance has already become, even before the real wave of digital demand hits the grid.
That brings us directly to how Vistra is positioning itself to capture that digital infrastructure demand. The market narrative for utilities right now is rapidly moving away from these weather-driven peaks and toward long-term tech infrastructure.
Yes, the AI boom is changing everything.
We really need to talk about the Helix partnership because this was arguably the most strategic announcement in the entire earnings report.
It certainly changes their whole profile. Vistra announced a joint venture with KKR, NVIDIA, and the Kuwait Investment Authority to create a brand new digital infrastructure platform called Helix. The stated vision is to build a rack-to-grid, one-stop shop for hyperscale data centers.
Let's define what a hyperscale data center actually is for a moment, because we aren't talking about like a warehouse full of standard servers.
Yeah, not at all.
These are facilities custom-built to train and run massive artificial intelligence models. They require staggering amounts of electricity, not just to power the chips, but to run the specialized liquid cooling systems that are completely necessary to keep those chips from melting down.
And that extreme power requirement is exactly why Vistra is in the room. Vistra is stepping in as the preferred power partner for Helix and has committed up to $1 billion to the venture over time.
Partnering directly with NVIDIA and private equity giants like KKR effectively shifts Vistra from a traditional, somewhat slow-moving utility into a tech-adjacent infrastructure play.
It absolutely does.
But pricing in tech multiples introduces entirely new operational risks. We are already hearing about severe bottlenecks in the AI build-out, right? Like transformer shortages, copper supply constraints, zoning fights, chip delays.
Oh, yeah, the supply chain is a mess.
Right. So if you are an investor, you really have to wonder if Vistra is committing $1 billion to an AI narrative that might be stalled by supply chain realities that are well outside of their control.
That is the exact risk profile you have to monitor when industrial companies start chasing tech valuations. But if you look at the mechanics of how Vistra structured this deal, it actually insulates them from those exact bottlenecks. First off, their $1 billion capital commitment is strictly stage-gated.
Meaning they aren't just handing over $1 billion on day one and hoping for the best.
Far from it. Any capital contribution over the initial $500 million is subject to achieving very specific, predetermined project milestones.
Okay, that's smart.
Yeah, if the transformers don't show up or the local zoning gets blocked, Vistra simply doesn't write the next check. Second, by acting as the preferred power partner, they retain vital operational optionality.
What does that mean in practice?
It means they can choose to build brand new contracted gas generation specifically to power a Helix site, or they can just sign long-term power purchase agreements using their existing nuclear and gas assets. They managed to secure a seat at the table with the absolute biggest players in AI while retaining the financial discipline and downside protection of a utility.
That stage-gated funding structure is really smart, and it suggests management is highly aware of the execution risks, which actually leads us perfectly into the actual headwinds that management flagged in this report.
Right, it wasn't all just good news.
Because despite the 30% EBITDA growth and all the flashy Helix headlines, the forward outlook has... Let's explain why a forward curve weakens, for anyone who might not know. Usually it means the market anticipates an influx of new, cheaper supply coming online, or they expect natural gas input costs to remain suppressed, which essentially lowers the marginal cost of power in the outer years.
Exactly. Whatever the exact driver is, the market is pricing in cheaper wholesale power 2 years from now. And because those prices have softened, management explicitly noted that this is pressuring their 2027 EBITDA opportunity range.
So they are going to miss the top end of their target.
Well, they are now guiding expectations toward the lower end of that $7.4 billion to $7.8 billion range for 2027. It is a really good reminder that even with AI growth, IPPs are still subject to raw commodity cycles.
And it was the second headwind they flagged?
The ongoing regulatory environment in Texas. The ERCOT grid operator and state regulators are currently conducting extensive grid audits specifically focused on data center interconnection queues. This is creating a huge layer of regulatory uncertainty. Infrastructure developers simply do not know exactly when or under what specific conditions they will be allowed to physically connect these massive new AI loads to the Texas grid.
This regulatory tension resulted in what I thought was actually the most compelling moment of the entire earnings call.
Oh, Jim Burke's comment.
Yes, CEO Jim Burke delivered a very blunt reality check on the entire AI power narrative. He pointed out that while the ERCOT interconnection queue is currently expressed as over 400 gigawatts, the actual physical data center demand that will materialize by 2030 is likely closer to 12 to 15
This
gigawatts.
is
He
amazing.
just completely gutted the sensational headline numbers being thrown around by developers and the media.
It is so rare to hear a CEO actively temper growth expectations in their own sector, but you have to look at the actual mechanics of an interconnection queue to understand why he did it. The barrier to entry for a developer to submit a project to the queue is financially very low.
So everyone just throws their hat in the ring.
Exactly. So you end up with massive amounts of phantom load,
Huh.
like speculative real estate developers and data center operators throwing theoretical projects into the queue just to secure a place in line, with zero guarantee they will ever secure the financing or even the chips to actually build the facility.
They are essentially taking out cheap options on grid capacity.
Precisely. Burke is looking right past that phantom load and focusing on the unforgiving physics of the grid. I mean, ERCOT currently operates with a peak summer load of around 91 gigawatts.
Right.
It is physically impossible to add 400 gigawatts of new demand to that system in the next 5 years. The transmission lines, the substations, the generation capacity, they simply do not exist. By anchoring the market's expectations to a highly realistic 12 to 15 gigawatt number, Burke is protecting Vistra's long-term credibility.
It also sends a very clear signal to regulators, don't you think? He's showing policymakers that Vistra understands the physical limits of the grid and supports measured, reliable growth rather than feeding a speculative infrastructure bubble that regulators would inevitably have to step in and crush.
Oh, absolutely. Expectation management is critical when you are operating in a highly scrutinized utility environment.
It keeps the regulators calm, and it sets a financial bar that Vistra can comfortably clear. So if we look past the regulatory hurdles and the forward curves, what does this operational performance actually mean for the balance sheet? Like, how is Vistra allocating the immense amount of cash generated from all these operations?
The capital allocation strategy is arguably the strongest element of Vistra's entire investment thesis right now. Looking ahead, Vistra expects to generate over $10 billion in available cash across 2026 and 2027.
10 billion, that's incredible.
And they have a proven, really aggressive track record of returning that cash directly to their investors. Since 2021, they have returned $6.5 billion to shareholders, primarily by retiring 171 million shares.
The underlying math on those buybacks is really eye-opening too. Their average cost for those 171 million retired shares was just $38. With the stock currently trading up in the $140 range, that represents incredible value creation for long-term holders.
Absolutely.
And they still have $1.2 billion remaining in their current buyback authorization.
But here's the thing. Executing buybacks at $38 a share is textbook capital efficiency. But it introduces a complex strategic question going forward. As the stock price appreciates so much, the accretion of those buybacks diminishes.
Because it's more expensive to buy them now.
Right. Every dollar spent on repurchasing shares at $140 yields far less value than it did back at $38.
Which brings up a very compelling tension regarding their future capital allocation. The ultimate tug-of-war for Vistra over the next 3 years is going to be balancing aggressive shareholder returns against the massive capital expenditures required to fund their growth projects.
And they have a lot of them.
Right. They've committed up to $1 billion for the Helix platform. They are still integrating the Cogentrix acquisition. They are developing the Permian Peakers, those fast-ramping gas plants out in West Texas designed to capitalize on grid volatility.
Yeah, none of that is cheap.
Exactly. These are all mid-teens levered return projects that require serious upfront capital.
It forces management to prioritize. If they choose to divert cash away from buybacks and toward growth capital expenditure, the market will demand flawless execution on those infrastructure projects.
And here's a final thought for you to ponder as you review your holdings. As the physical demands of the national grid intensify, will Vistra eventually have to make a hard choice? Will they have to choose between keeping their dividend and buyback investors happy and funding the sheer amount of steel, concrete, and turbines required to power the AI revolution?
It's a huge question.
You can only stretch $10 billion so far when you are actively building the backbone of the digital economy. Eventually, you have to decide if you're going to use your cash to pay down the mortgage or build a massive new addition to the house. Make sure to follow the show for daily, no-fluff earnings coverage right here.